Good morning. My name is Estelle Parker. I'm the Executive Manager of Programs at RIAA. I'd like to start by acknowledging that I'm chairing this launch today from Wurundjeri country, where we're currently just entering paw neat season, or tadpole season, which is characterised by the arrival of tadpoles as well as lilies, kangaroo apple flowers and currajongs. And I think we're already starting to feel that warmer weather and those longer days that paw neat season will bring here to Wurundjeri country. So I'd like to thank and pay my respects to all of those who have cared for this land for many, many seasons, and all First Nations elders past, present and emerging. It's my great pleasure to chair this year's launch of RIAA's Responsible Investment Benchmark Report. This is the 20th annual benchmark report that the Responsible Investment Association Australasia has produced. And I'm very pleased to announce that RIAA now has over 400 members, representing around $40 trillion in assets under management globally. RIAA's purpose, as our members will know, is to promote, advocate for and support approaches to responsible investment that align capital with achieving a healthy and sustainable society, environment and economy. So in addition to RIAA's working groups, our major national conferences, our policy work and of course our world-class certification program, the research that RIAA does is a key way that we support the alignment of capital with sustainability outcomes. So, but by providing you with the data and insights, we hope that it's easier for you to do your jobs. This report, I think it comes at a time when we're seeing a huge amount of momentum globally around sustainable investment. We've got legislation in the EU, developments in other countries, work through the Task Force on Climate-related Financial Disclosure, Task Force on Nature-related Financial Disclosure, work going on through the CFA Institute and so on. And there's this sort of rapid pace of change at the moment. And one thing that this report clearly shows is that the expectations of responsible investment are being reset globally, and that Australia is not immune from this trend. So there's this sort of push towards better standards of practice in the industry. And therefore, there's never been a more important time to focus on what's going on in Australia's responsible investment market, which is why we're here today to understand the findings of the 20th Annual Responsible Investment Benchmark Report. In a moment, we'll take you through the report's key findings, and then we'll have a panel discussion to interrogate what the key findings mean for the sector and for you. And as we go through today's launch, please feel free to use the Q&A function to send any questions to the panel, and we'll do our very best to answer them. A little bit about the report. The report was prepared by RIAA and KPMG. It uses data from publicly available information as well as through a survey. And I'd like to acknowledge the data report that we received from Morningstar and thank Morningstar for that support. And also take this opportunity to sincerely thank the 59 investment managers who filled in the survey. This report would not have been possible without you. And the report would also not have been possible without our valued business partners. So sincere thanks to AXA Investment Managers, BT and Australian Ethical Investment for helping to bring us this report as sponsors. And the report would certainly not have been possible without the authors, two of whom it is my great pleasure to introduce, two members of the incredible RIAA team. Nicolette Buller has held numerous leadership positions in sustainable finance and in the environment sector. She's worked in a range of organisations, institutes and authorities over the past 30 years. And she's an expert in sustainable investment, currently RIAA's Executive of Policy and Standards. She was involved in the Australian Sustainable Finance Initiative and is currently a member of the Principles for Responsible Investment's Global Policy Reference Group. She's been involved in the development of the benchmark report for the past 3 years. Zsuzsa Banhalmi-Zakar has extensive record as a researcher. She holds a PhD in sustainable finance and has spent time in academia, as well as with investors, the not-for-profit sector and in consulting. She now heads up RIAA's research program. And Zsuzsa led the development of this year's benchmark report in collaboration with KPMG. So Nicolette and Zsuzsa will now take us through the report's findings and announce our responsible investment leaders for 2021. Over to you, Nicolette and Zsuzsa.
Thank you, Estelle. And first off, I just wanted to paint the picture. So 2020 was weighed down with the strains of climate change, and it was most certainly disrupted by the shock of COVID-19. And our report's findings must be considered in that context. So I'm just going to spend a few minutes to walk through what I've classified as 2020's 3 Cs: climate, COVID, and culture. So on climate, so we kind of choked our way through the worst bushfire season in living memory. But the year started strongly with a continued focus on climate as a specific risk to the functioning of global financial, monetary, and economic systems. We had the EU's Sustainable Financial Disclosure Regulations and its taxonomy of sustainable finance kickstart sustainability-related risk reporting, including climate. We had New Zealand mandating to start TCFD reporting next year, with the first reports coming out in 2023. Asset owners and investment managers were climbing over themselves to make net zero emission reduction commitments. And then with the US presidential election outcome in November last year, this just created further impetus towards a truly global effort to decarbonise the world by 2050. When December hit, we had countries responsible for the bilateral offtake of 75% of all Australia's coal and gas exports having net zero targets by mid-century. So in support of this and UNEP-FI's study that showed that more than half the world's $4 trillion of output is highly or moderately dependent on nature, that Task Force for Nature-Related Financial Disclosures was also born. That's the TNFD. And in July this year, RIAA launched its dedicated working group to support members to better engage with this emerging risk area. Also last year on climate, through the legal prism, we had the McVeigh versus Rest case, which provided Australian investors with the minimum standards in terms of climate action and disclosures for super funds. And the Hutley opinion on fiduciary duty reaffirmed that when trustees manage financially material risks such as climate change, they are acting in the best interest of their beneficiaries. So what about COVID? What to say? It just further highlights inequalities, the digital divide, and really that our most valuable workers are also likely to be the most poorly paid. There's the nurses, the teachers, fast food delivery, people, couriers, right? And from an industry perspective, we need information, we need systems, we need leadership for responding to and recovering from these exogenous shocks. And probably the shining light out of this is that the world's largest economies, including the US, the EU and China, are focusing on green growth in their post-COVID-19 recovery plans. So to my third C, which is culture, and culture as part of ESG, I suppose, and C, but also culture as part of the strengthening and growing impact of the RIAA membership in the real world. So in 2020, that was the year that we brought ourselves to work from our bedrooms, Exhibit A, and this meant that we are literally bringing ourselves to work. And it became harder to separate ourselves as workers from our roles as children, parents, students, and so forth. And so it became not just okay, but expected that we care for ourselves and for each other. From where I sit, I saw this playing out big time with how investors behaved as fiduciaries. Investors push harder than ever before with companies who are challenging them on their industry association memberships, running counter to society's trends, and even publicly lobbying governments to improve cultural heritage protection laws. We witnessed publicly structural questions around workers' rights and protection stemming from the aftermath of the pandemic, and we even watched the consequences of a form of semi-universal wage being tested. We voted on REM related to gender-based violence and equality agendas, and reported on modern slavery risks in our supply chains. And many took their first step on that journey to truly understanding what Black Lives Matter means in the Australian context. Free, prior, informed consent, well known by the banking sector, is definitely well known also by members of the Human Rights Working Group, and that Duke and Gorge, Rio Tinto, inadequate response to that atrocity showed us that just because something's legal doesn't mean that it's right. And then in November, last but by no means least, the Australian Sustainable Finance Roadmap was launched. And it was a ridiculously ambitious industry-led collaboration where investment managers, insurers and bankers turned policymakers. And those 37 recommendations, which are in earnest being implemented by members of that initiative, have put forward as a priority having their own sustainable finance taxonomy and supporting the establishment of the First Nations Economic Empowerment Office. Still on culture, the industry remains on notice. There's never been more column inches dedicated to the discussion and accusations around greenwashing. ASIC started its review on the prevalence of greenwashing in the marketplace, but it's important that not all of us yet realise that whilst ESG integration is critical to better long-term performing companies and investments, it alone doesn't lead to improvements in the real economy. And for the industry's continued social licence to operate, it's just critical we don't mislead investors and the public about those features and characteristics and the sustainability ambition of the products we promote. Thankfully, though, we do have RIAA's certification program to help with that. So climate, COVID and culture, that's the year that's 2020. And now to Juja for the findings of RIAA's 20th Responsible Investment Benchmark Report.
Thank you, Nick and Estelle, for a wonderful introduction, and good morning and welcome everyone to our report launch event. I'm very excited to share with you some of the most important and interesting findings we have discovered this year. The 2021 benchmark report for Australia consists of over 35 pages, 34 figures, and 5 appendices. So obviously, there is not enough time to present the entire report to you today. So what we did was selected the most telling, interesting, and perplexing key findings for you, which should provide for an interesting panel discussion later on. The figures that you'll see today are taken directly out of the report, but we have annotated them with additional information, mostly key numbers and percentages. Okay, so next slide is basically what is becoming a bit of a signature slide for our benchmark reports. It reveals the size of the total investment market at almost 3.2 trillion. This is the yellow band. The size of our survey, which is the blue band, and the size of the responsible investment assets under management, which is the green band. We will look deeper into these numbers in the next slides, but I just wanted to also highlight that the figure also shows our methodology. So we sent out 198 surveys, we received 59 responses and conducted desktop research for those that didn't fill out the survey. Now let me direct your attention then to the green band, which is what we designate as responsible investments assets under management. Here, we only count the contribution of responsible investment leaders. And these leaders are investment managers who scored at least 75% on RIAA's responsible investment scorecard. So in addition, we only capture the value of assets that are managed responsibly amongst those leaders. In other words, we first assess the organization, and when we are confident that they have the right processes in place to manage investments responsibly, we then only count the value of those assets. The next slide shows the size of the responsible investment market compared to the total market in Australia over the last 3 years, and it has a big story to tell this year. Each year has 2 stack bars. So on the left-hand side, we have the numbers in billion dollars, and on the right, we have proportion as a percentage. What we see here then is that both the blue bars and the green bars are increasing year on year, indicating that both the size of the total market and responsible investment is growing. But what is particularly telling is that funds engaged in leading practice responsible investment have seen an explosion growing to about 30% in 2020. This movement of capital has come at the expense of the remainder of the market, or the blue bars, which have seen the value of assets shrink by 11%. The next slide shows what proportion of assets are managed through at least one responsible investment approach. We will talk about what these approaches are in more detail in a minute, but for now, what is impressive is that nearly 3/4 of investment managers apply some type of responsible investment approach to a total of 100% of their assets under management. Another 16%, or the blue section, manage more than half of their assets through at least one such approach. So altogether, nearly 90% of investment managers that claim to be engaged in responsible investment in Australia apply some type of responsible investment practice to the majority of their assets. The next slide conveys information about average performance of responsible investment compared to various benchmarks. So the average performance for responsible investment comes out of our survey data, while the benchmark figures were provided by Morningstar. Here we report weighted average performance net of fees at 1, 3, 5, and 10 years. This year we used 3 colors. So the green cells show responsible investment funds performing better than the benchmark. The The yellow shows that responsible investment funds performed on par with the benchmark, staying within 1%. And the gray colored cells show underperformance. So the figures for this year don't really present a coherent story on performance. And while it's too early to say definitively what impact COVID-19 had on the economy, fund performance worldwide has been impacted by the pandemic, no doubt. So just to compare, in 2019, the average returns of responsible investment funds and the benchmarks in Australian share fund category, for example, was around 22–24%. In contrast, in 2020, we are seeing averages returns below 2%. In the Australian share fund market, responsible investment funds remained on par with the Australian Fund Equity Large Blend and the ASX 300 for the 1 and 10-year time horizons, but underperformed over the 3 and 5 years. So we did some, of course, head scratching around that. And what possible explanation is that companies with mid and small market capitalization, which are included in the ASX 300, but not in the Australia Fund Equity Large Blend, fared better than large market cap equities in 2020 overall. Finally, with this slide, we'd just like to highlight that we expect that the performance of responsible investment funds and the benchmarks will eventually converge as more and more assets are managed through one or more responsible investment approach. And I'll hand over to Nicolette to introduce the next section of our presentation.
Thank you very much, Zsuzsa. So responsible investment approaches. Again, we have the responsible investment spectrum, and it goes from, I'm just having a present because I had some notes on this, but I don't have those notes, so here we go anyway, because I'm very familiar with it, like most of you are. It has 7 approaches to responsible investment, going left to right: ESG integration, exclusionary negative screening, norms-based screening, corporate engagement, positive best in class, sustainability themed, and impact investing. Now, we still use this spectrum because it's useful for us to classify and compare the growth of responsible investment year on year in Australia, but also the growth of responsible investment in Australia in comparison to other marketplaces that use the same classification system. What's changed though is, and I'm sure a lot of you who are involved in this will know, is that no longer do managers do just 1 or 2 of these. They actually deploy the complete suite of these responsible investment approaches. So what's changed this year and sort of what's on notice for next year is, firstly, corporate engagement and shareholder action isn't in the middle here. It's something that underpins just good responsible investment. So I'd like to see that go right across the whole spectrum. Really importantly too, we've taken best in class screening and probably applied it to ESG integration. It's part of the same family. So all it does is it adds a screen or a threshold to the extent of badness or goodness, if you like, that managers are willing to have exposure to when they take into account ESG factors. So next year, you'll see some convergence of those 2 approaches. But what's really important is that this spectrum now really is ESG integration, the exclusionary screens and norms-based screens, and corporate engagement, all indicating leading practice responsible investment. But the real leaders for the 2020 decade is going to be those that also can target sustainability themed and impact investments as well. So that's what's going to make responsible and what's different in the spectrum going forward. Those 2 at the top and the rest underpinning good quality responsible investment practices.
Okay, thanks, Nick.
Over to you, Zsuzsa.
Thank you. Okay, so in this figure, you see the approaches that you just saw in the spectrum, but they're just listed top down here. And the green bars represent the new data and the blue bars are from last year. And we just disclosed that for comparison. So on the bottom axis, you see the total assets under management. So these are not the responsible investments assets under management. So what that means that if a fund employs both negative screening and positive screening, we count it for both approaches. And we do this because we want to compare which approaches are used most in Australia. So what we see here is that of the 7 approaches, ESG integration, negative screening, and corporate engagement and shareholder action are by far the most common. Compared to 2019, we see that sizable increase in corporate engagement and shareholder action at 15%. And we see a small drop in sustainability themed investing, a larger drop in positive screening. And despite its small base, we see a 40% increase in impact investment. So impact investment, of course, includes a wide variety of different products. In 2020, we included 145 products, which is a jump from 111 in the year before. In our benchmark report, we consider green, social, climate, and sustainability bonds in that impact investment universe. And really, the bonds alone make up 88% of impact investments by value. So the rest of impact investing is real estate, private debt, public equity, private equity, social impact bonds, and so forth. So it's a very diverse range. So on the next slide, we wanted to showcase some deeper insights from the report on some of those approaches. Here we're looking at sustainability themed investments. So on the left-hand side, you see the breakdown by sustainability theme. So this is basically what investment managers offer in their products. Climate change and natural capital related themes are really prominent, similar to 2019. The natural capital theme includes investments in sustainable land management, healthy waters, and biodiversity preservation. We also see investment in healthcare appear, along with sustainable transport as the third most common theme. And no doubt, the investment in healthcare is a result of the COVID pandemic, but it also shows how quickly the professionally managed investment market can respond to emerging trends. On the right-hand side, then you can see the breakdown of a year's worth of searches on RIAA's Responsible Returns Online tool. This tool is publicly available and it works by consumers selecting themes to include or exclude when looking for investment products. The two graphs together reveal that the themes consumers seek are aligned with the products responsible investors offer, but it's still worthy to note that social themes, including impact investments, are frequently sought by consumers, while this sustainability theme dropped since 2019. So I would say that perhaps there is an opportunity there to develop and market products in those social themes. The next approach I wanted to show you is the diversity investing class or positive screening on offer in Australia. Positive screening altogether declined from 102 billion to 64 billion assets under management in 2020. But really the breadth of coverage is impressive. We see positive screening mostly apply to environmental issues, so climate change, sustainable water management, circular economy, and recycling. It is interesting to note that the top social issue is human rights, so this really aligns well with some of the background that Nick has highlighted already, and also gender diversity. Perhaps human rights is a top social issue. It's not as surprising given that the reporting requirements were introduced for the Modern Slavery Act since 2019. So next up, let's flip the coin here and look at exclusionary practices. This is negative screening. Negative screening decreased by 22 billion compared to 2019, but it still remains the second most widely used responsible investment approach in Australia, so extremely important. This year is a combined figure, which shows the percentage of consumer searches in green. And again, using RIAA's online responsible return search data for the year 2020 in blue. What is apparent is that consumers seek products that exclude fossil fuels, which responsible investors offer, which is what I circled there. What is also apparent then that there are some gaps between the green and the blue bars. So gaps between consumer preferences and products offered in other categories. For example, a large proportion of assets under management exclude investments in the tobacco industry, while consumers are not actively searching for such products. This may be because consumers already expect that this is happening. At the same time, consumers are looking for products that exclude human rights abuses, environmental degradation, but what we see is that these products are more scarce and possibly not meeting consumer demand. So again, this could signal an opportunity for responsible investors. Next up, we have the slide on which shows which treaties and international conventions are used in norms-based screening. Norms-based screening works by excluding activities if they violate various conventions and international agreements, or they include activities or investments if they adhere to norms. So it's like a positive and negative screen altogether. Norms-based screening increased by 5 billion to 219 billion in 2020. It ranks 4th among the 7 RI approaches. And here we see that the UN Global Compact is at the top of the list, which is the world's largest corporate sustainability initiative that encourages companies to align their operations with universal principles on human rights, labor, environment, and anti-corruption. The principles for responsible investment is second most common. And of course, this initiative is tailored to the investment market. So it's highly relevant to our survey subjects. Again, here, what is interesting, you can see the upturn in the use of UN guiding principles on business and human rights, doubling from 25% to 50%. So again, emphasizing the importance of human rights on the horizon. So next up, of course, we have to talk about ESG integration practices, which remain the primary approach used by investment managers in Australia. And in 2020, it grew to an impressive $628 billion of assets under management. This data point captures the entire research universe. And what it does is really shows how the coverage of responsible investment expanded in 2020. If you look at the green bars, you see that 57% of investment managers in Australia apply ESG integration over the majority of assets under management across equities and fixed income. And the big difference is in the yellow bar, which decreased substantially and was, I guess, essentially absorbed by the green bar. This really indicates that organizations that already employ ESG integration in one asset class are expanding and diversifying to include additional asset classes. So it's a very encouraging sign indeed. Finally, we wanted to show you what progress has been made in terms of transparency and accountability in the sector. We asked survey respondents to indicate whether they disclose if and how they engage with companies and shareholders. And we also asked if they report on outcomes of these actions. We see very encouraging results. And again, green bars are the new data, blue bars are for the previous reporting period. Firstly, corporate engagement and shareholder action increased 15% from 409 billion to 471 billion in 2020. Secondly, we see a jump in reporting on both corporate engagement activities and outcomes from only 21% to 31%. These are indeed big strides in accountability around engagement and voting called for by investors and civil society. Reporting on engagement is expected to continue to strengthen with important stakeholders like the Australian Council of Superannuation Investors and Climate Action 100 among those who started reporting on engagements. So we routinely ask our survey respondents around key deterrents, so enablers and barriers to responsible investment. So on the next slide, we show that survey respondents had nominated the top 3 growth factors, and 40% indicated here that demand from institutional investors was the predominant factor. Investor demand is driven by ESG considerations embedded in the investment process and enables managers to assess risks and opportunities. This further supports our findings that ESG integration is a mainstream process in portfolio decisions. Growing interest by underlying investors to align investment with mission and/or values remains the second largest driver, followed by the growing acceptance that ESG factors impact the financial performance of those investments. Here, survey respondents saw no performance trade-off as a result of greater ESG consideration in their investments. And the flip side of this, of course, are the barriers to market growth. We find that the 3 main barriers to growth remain the same, although the order differs slightly compared to 2019. We have lack of understanding or capacity to apply responsible investment at 32%, lack awareness by members of the public and responsible investment, and performance concerns. A welcome result is that investment managers are more confident with the returns provided by responsible investment funds, and they are less concerned about performance of responsible investment in 2020 than they were in the year before. So while there are no simple or quick solutions to overcoming these top barriers, as it will take time, resource, and effort by a mix of stakeholders, it is encouraging that despite these difficulties, we close with an impressive improvement in responsible investment in Australia this year. And on that note, I pass the baton over to Nicolette.
Thanks very much, Shuja, and to the great reveal, or nearly. So the responsible investment scorecard results for 2020 are both good news and not so good news. The good news is that there are more responsible investment managers in 2020 than there were in 2019. In fact, 23% more by number. So that's those scoring at least 15 out of 20 or 75% on the responsible investment scorecard. But the number makes up the same proportion of the market in 2020 as it did in 2019. In other words, 27% of the market can claim to be leading responsible investment managers. So by number, this year we have 54 leaders. So to be classified as a leader, investment managers were scored against 4 pillars of leading practice based on publicly available data and any additional information they're provided by survey. Thanks, Bryony. You can find the scorecard in the report's appendix. Just wanted to point some of these out here. Responsible investment leaders demonstrate strong collaborative stewardship and consider ESG factors explicitly and systematically when they value assets and they allocate capital and build portfolios. They're decidedly transparent, and this is really key. They report publicly, not just on their activities to manage ESG risks, and to improve environmental and social sustainability, but also on the outcomes that they do or don't achieve. And so thanks to Zhuja, for the first time this year, we compared the performance of the leaders with the non-leaders on these 4 pillars of the scorecard. And we found that for pillar 1, that's commitment to responsible investment, there's really not that much difference between them. Interestingly, both leaders and non-leaders falter when it comes to telling clients what's in their portfolios. So the leaders still only 69% of them provide full holdings disclosure. In terms of pillar 2, risk management, and pillar 3, stewardship, this is where we saw the gap widening between leaders and non-leaders. So in the stewardship is the pillar that leaders really excel at. These leaders are just better at telling us about the issues that they engage on and how they vote, and also showing the difference that these activities are making in terms of outcomes achieved. The leaders are particularly good at ESG integration and disclosing revenue and activity thresholds to any of the screens that they apply. And all these factors contribute to higher scores. The area where both leaders and non-leaders perform the weakest is pillar 4. And this pillar was added 2 years back when RIAA realised that we really do need to start to signal to the industry that using finance to target social and environmental sustainability challenges needs to be the new norm for responsible investing in this decade. So the average score of leaders was 3.2 out of 5, while the average score of non-leaders was less than 1. So Bryony, please reveal the responsible investment leaders for 2020 in Australia. Congratulations and thank you to this year's leaders. I really want to be able to ask Bryony to put both slides up to next year. So get leading. Thanks, Estelle.
Absolutely. We certainly seem to hope to see that list much longer next year. Thank you very much, Nicolette and Zhuja. Congratulations to those who made the leaders list this year. And congratulations to you, Nick, Zhuja, and all of those involved in the report from KPMG and from RIAA for this very important contribution to our understanding of the state of play. We'll now be joined by a panel of eminent experts to explore the report's findings. And a reminder to input any questions through the Q&A function. So I'd like to introduce, first of all, Grant Kennaway. He's another experienced researcher. He's also worked as a funds manager and as an analyst. And prior to joining Morningstar Financial Services and investment research firm in 2011, Grant was general manager at Lonsec. He's now Morningstar's Director of Manager Research. Jessie Pettigrew has extensive experience in corporate sustainability, including at Westpac Group and in the property sector. She is now Head of Sustainable Investment and ESG Risk at BT. John McMurdo is an experienced CEO and director in the financial services industry and has also worked with a range of startup and accelerator businesses across a variety of sectors. He's currently the CEO and Managing Director of Australian Ethical Investment. Chris Willey has extensive experience in property and property investment. He's currently fund manager in real assets with AXA Investment Managers. And finally, Mark Spicer has been with KPMG working on sustainability issues since 2003. He's an expert on climate and modern slavery risk and reporting and is currently Director of ESG and Responsible Investment at KPMG. Mark led KPMG's involvement in this year's Responsible Investment Benchmark Report. Welcome all. Now, as we've just heard, there are some fascinating and highly relevant findings from this report, and I wanted to start with one of the key takeouts, which is that responsible investment assets have grown at 15 times the rate that overall Australian professionally managed investments are growing. So let me start by asking the panel their view as to why leading practice responsible investment is growing at 15 times the rate of the market. We might start with you, Grant.
Thanks for the question, Estelle. It's a pleasure to be here. Look, we know there's an increasing number of investors that are taking a deeper interest in how their money is managed and they're investing more in line with their values. Now, those asset managers that have long focused on responsible investing are attractive to this increasing pool of investors. Leading asset managers have been consistently telling their story, communicating their message to the broader investing public through means like best practice disclosure. And these asset managers are now benefiting from record fund flows and record assets under management. Now, those asset managers that haven't been on this responsible investing journey, like they're racing to play catch up. You know, they're crafting new messages. They're sort of a long, long way behind best practices and sort of lacking credibility. So they're, behind the curve, behind the leaders. Now, if I look at Morningstar's own fund flows data focused on retail investors, this shows that there was a 66% increase in assets invested in Australian sustainable investment strategies in the year to 30 June 2021. So look, these are incredible numbers and the leading firms have benefited. Also, the development of more rules-based sustainable passive strategies. This has also attracted a healthy amount of fund flows, building that pool of assets. The final point I'd make is that, once people have invested in a sustainable investment strategy, we know from Morningstar's own research that this money is quite sticky. And then what I mean by this is if your investments align with your values, you're more likely to sit tight even when markets are volatile. And we saw this in action when markets tanked in the first quarter of 2020. And yet sustainable investment strategies, not only did they retain capital, they actually continued to attract inflows. So this attribute is a healthy advantage for investors and for the leading asset managers that they're investing with.
Great, thanks very much, Grant. John, would you like to make a comment on that growth?
Yeah, look, Estelle, actually, let me start by saying how thrilled Australian Ethical is after 35 years of pioneering ethical investing in Australia to see money moving in the right direction for the variety of reasons that do exist. And congratulations to RIAA for your significant role in that as well. The more money that's invested responsibly, the better off we'll all be as a planet and as a species. Our own research, Estelle, over many years completely supports the RIAA findings. To me, it points to, I think, three key drivers as to why Australians find their way to a so-called leader, such as Australian Ethical. And the first of those is that Australians in substantial numbers now understand the urgency to move on climate change in particular. The IPCC report a couple of weeks ago, I think, has been seminal. The Lowy climate poll earlier this year, saying 74% of Australians believe the benefit of climate action now outweighs the costs. And so, with that urgency and criticality understood, they want us to invest in, or they want to invest their money with those managers most committed, deeply committed, to changing the current trajectory, not those with only a cursory commitment. The second thing we've seen is that they want a manager that cares about and considers a more holistic range of issues. You know, the research is right that climate is number one, but Australians also increasingly care about issues like modern slavery and exploitation or social impact, and so that they prefer managers that more fully align with their values and beliefs, not just conveniently, you know, divesting from BHP because it seemed to be the right thing to do. And I think the third and I think biggest determinant in recent times, Estelle, you know, I think has been authenticity. You know, Aussies, you know, have a very good nose for BS, particularly in a world where, you know, information flow is democratized through social and other channels. You know, there is a big difference between, on the one hand, you know, changing your brand and divesting from a couple of fossil fuel companies, and on the other hand, you know, an authentically ethical investor. You know, offering an ethical product as part of an array of products and being an ethical company are not the same thing. So, you know, it's not just about investing, it's also about being advocates for that change. And so consumers, you know, want to see deep commitment in all aspects of running our businesses. They want to associate with brands that reflect their own values. So to me, Estelle, the results show that it's not good enough to simply claim you're investing responsibly, you know, or do it at the edges. If it's not in your DNA, if you're not doing it authentically and well across your whole organization, then you will be sniffed out.
Absolutely, John. And I think, I mean, that is one of the findings of the report, that it's not good enough just to be doing it. You need to be doing, or say you're doing it, but you need to be doing it well. And we'll talk about those consumer preferences and interrogate that a little bit more further down the panel. But Jessie, I wanted to bring you in now. From Jessie from BT, why do you think leading practice responsible investment is growing at 15 times the rate of the market?
To be honest, I think Grant and John have really covered, you know, the main themes that we see here. And I'd also just point out that the data that we see coming through on our platform products is absolutely representative of this too. So the funds that we would say, the funds that prioritize sustainability, so the ones that, you know, actively trying to achieve a sustainable outcome, have seen some really considerable growth on our platform over the past 2 years. So it's kind of quite impressively 420% over the past 2 years into those funds. But you know, even just over the past year, that flows into those funds have more than doubled. And our kind of understanding, you know, from speaking to advisors who use our product through to kind of end clients, is that it's coming, you know, as Grant and John said, it's coming absolutely from consumer, you know, demand. I think part of that is, you know, what we've said, that consumers are getting more interested, and part of that is, you know, part of that is you know, millennials coming through and, you know, younger investors coming through. I started my career in sustainability about 10 years ago. Been working in financial services for, you know, 7 years. I've been at BT for 4 years in investments, and I have, you know, through my whole career read, you know, report after report saying when millennials come to investing, we're going to start to see that money flow through. Well, millennials are old now, sorry to say to the other millennials on this call. And that's you know, part of what we're seeing. And it's not just millennials. I don't want to take credit for our generation, take credit for all of this, but I think they're kind of leading the way here, and it's indicative of, you know, consumers becoming more aware of some of these issues. I think the other thing that comes through in this data is it is really being led by institutional investors, and that's, you know, that's where we sit as a fund manager in this space as well, in addition to the platform. And in that sense, it's become mainstream. It's not a question anymore about, you know, does an investment manager implement sustainability? It's how does an investment manager implement sustainability? And if you can't talk to your approach to ESG, then, you know, that's a pretty clear flag for us as well.
Thanks, Jessie. And yes, there are certainly impressive stats about flows into those funds, and that's certainly backed up by the report. Chris from AXA, did you have anything to add?
Well, this is a risk of going fourth, isn't it? 'Cause it's basically all of the above. Look, I think from our perspective, leading practice RI high growth compared to business as usual non-leading RI. I think investors are focused on the currents, so they can see these big macro trends. Science is clear. and the scientists' message is becoming more confrontational with each new report that we receive, that we have to decarbonise rapidly. It's obvious that there needs to be a substantive, meaningful response to climate change that collectively we're facing. I also think that markets are generally ahead of the curve with regards to government policy. And if you said that 5 years ago, that was an absolute no-brainer. But there's been some substantial changes in the market over the last 12 months. The IPCC report, Biden administration, this rush for net zero targets, and to be honest with you, whether it's 2060 or 2050, I think the point is that there are targets, and I think those targets will pull in over time. So people dip their toes in the water with a long-term target and then bring them in. And probably the last thing I'd make, or last point I'd like to make, is leading practice, RI, to John's point, actually interject all the other panelists' point, it is not really a nice to have for us. We like to see ourselves as an alpha value add manager, and this is normal behavior now. That this is not a bolt on that you can just pull off the shelf as and when required.
Absolutely, thanks, Chris. I think what's behind that growth could certainly be another topic of future RIAA research. Look, I'll bring back RIAA's research manager, Zsuzsa, for surrounded by investment managers, Zsuzsa, for a moment. Zsuzsa, one of the key distinctions made in the report is between responsible investment leaders and non-leaders. Can you explain a little bit more about the difference between these two groups and what makes a leader different from a non-leader?
Yeah, sure. Thanks, Estelle. So if we bring up that slide that we showed earlier, this is the average scores of leaders and non-leaders. And so the scorecard, the way the scorecard works, I'm sure there'll be a lot of questions from those who are really keen to become leaders around this, is that we're looking at 4 pillars, and the scorecard itself is actually an appendix in the report. So it'll be, it's available for everyone to have a look at, and a breakdown of some of the questions. So behind each of those pillars, we have a number of questions. The pillars are listed there. What is important to note that the weighting of the pillars is equal. So we had a total of 20 marks, each pillar is 5 marks. And so those are the average scores there. So what I also did that is not on this graph is I also averaged the scores for each of the questions within each of the pillars, just to see which question is really where we see the biggest gaps or biggest differences between leaders and non-leaders, and what they're doing better or worse. It really, I guess what is important is that, in pillar 1, where we have commitment to responsible investment, and we see the leaders and non-leaders both do really well there. So the things that we cover here are policies, any evidence really of reporting practices, commitments, very high level things, and everyone's already there. So almost everyone's operating at leading practice, but this is really the first step. The nitty gritty then comes in the next 3 pillars. So the systematic process to ESG, risk management, we see a big gap. So what it's saying that leaders are much better at having those systematic processes and communicating it to us and to the external sort of the public. Similarly, with being strong stewards for more sustainable and resilient markets. So we see the leaders are much better at targeting that. They have the mechanisms in place. They have it, pretty well packed down how to do this right. Allocating capital to target sustainability outcomes is weak. Really, nobody is really performing at, on average, really at leading level. So I would expect that we will dig deeper into this in next year and possibly change some of the questions in the scorecard just to refine and find out exactly what is going on. So really where the non-leaders weren't doing well then are in revenue activity thresholds and disclosing those partially or not at all, or we didn't see any evidence of that. That's pillar 2. and most of pillar 4 then, which was around outcomes and also around disclosure of holdings.
Great, thank you very much, Uja, for so clearly explaining that, and congratulations again to our responsible investment leaders for 2021. They're really those organisations that are demonstrating those qualities that Uja just described, and as we said, we really want to see more leaders on that slide next year. Now, turning back to an important issue for all of us, which is climate change. As Nicolette described, the report really describes an industry that's in transition. There are developments taking place globally and within Australia where expectations of sustainable investment really are being reset. Chris, AXA has been named a responsible investment leader this year. AXA has a number of products certified as responsible investment by RIAA and has attempted to better align its portfolio to climate change issues. Can you explain what have AXA's drivers been in this, and what have you done as an organisation to push forward as a leader? And I might also ask you, Chris, what advice would you give to those who want to develop, deepen their impact?
Okay, so at high level, our driver for activity in this space is this macro theme of climate crisis and without being too dramatic, a limited time frame to avoid some of these more extreme scenarios. What does that do for us? That leads us to a clear focus on 3 key points: decarbonisation, climate resilience, and then a shift in policy to support both of those 2 pillars. This isn't new for us, but we have seen an acceleration in 2021, both in government ambitions and in science updates. For us, this is about clear pathways to net zero, and I can't stress enough our 360-degree focus on engagement. So that's engagement with clients, industry groups, service providers, upskilling our own staff, and it's an openness and general transparency. And just on that particular point, because transparency has come up a couple of times in the report, just by way of an example, the days of motherhood statements and non-smart measurable targets and reporting back on those targets are long gone. So depending on the audience with whom we're engaging, we will talk about net zero. We'll talk very specifically, for argument's sake, about, are we talking about scope 1, scope 2, scope 3, and the timeframes associated with that. So it's very specific, it's very non-fudgeable, because there's reputational risk, and also you risk not getting anything done. Leading for us means becoming a signatory to and an active participant with groups such as the Net Zero Asset Managers Initiative and the Investor Group on Climate Change. Traditionally, a lot of the managers would have kept our cards close to our chest, but look, this is a global issue, and collaboration and willingness to share is essential. At least the science-aligned targets and benchmarks that give real results. So one thing on another thing on leadership is it's not all negative. Like, there are opportunities there. So we've last month we purchased a forestry portfolio in the Green Triangle down in South Australia, and the reason why that's a bit of a pivot and looking to lead in new investment opportunities is, forestry, low carbon construction materials with significant growth globally. Improved forestry management leads to better biodiversity protection and growth. And there are also some carbon sequestration opportunities through forestry as well. So there are opportunities, and we see that as a leadership piece that we're taking on. And probably finally, very quickly, leadership for us would mean active participants and leading in the task force for nature-related financial disclosure. So a recognition that biodiversity forms a really important piece of this discussion. Advice, the last part of your question. I'm always telling my family off for not answering questions that I ask them, but you did ask a question about. I'm
sure many on this call would be really interested in what advice you have.
I didn't ask that question. You've asked something different. I think when I talk about currents, I focus on the currents and ignore the waves. I think, you know, September 2021, the macro issues are now well known enough. Parties need to work out what's important for them, what's critical for their business, and set some very specific metrics to use to measure and report back on performance.
Yep. Thanks very much for that. Chris, we did have a question for the panel, which is about the IPCC report and whether 1.5 degrees is still a realistic target, and sort of around those expectations around TCFD reporting. When is that shift going to occur? Chris, are you happy to take that question?
Yeah, so for 1.5, you can now, International Energy Agency produces, you know, a pathway for 2050, 1.5 degree aligned target pathway that sets out in 5-year chunks what needs to happen. So at property level, for argument's sake, you know, we're looking at full electrification of buildings. So again, to my point about metrics and performance targets, you need to break down this bigger picture into something that's a bit insurmountable, into a coordinated, maybe not bite-sized chunks, but some specific deliverables that lead to that greater outcome, if that makes sense.
Yeah. Thanks very much, Chris. John, before we get talking about consumer preferences, Australian Ethical has also been named a responsible investment leader this year. Congratulations. Are you able to give any advice to others who are interested in moving into that category of leaders?
Yeah, thanks, Estelle. Yeah, I can, would love to. Look, my advice would be, you know, embrace it as a business philosophy. You know, Australian Ethical has, you know, as you've alluded to, 35 years of DNA build-up, and so that doesn't come easily. But what I would suggest is, you know, before rebadging your product names or asking your marketing team to say similar things in a different way, even before revisiting your own corporate net zero targets, my advice is to actually revisit your purpose, your contribution to the world, and go all in. You know, it's no good to be cutting emissions in one part of your portfolio if you're making the climate emergency worse elsewhere. You know, Australians, we think, want to have confidence in their investment managers, in us as great corporate citizens, as great global citizens. And so, you know, even for those of you like us that are for profit, you can be both for profit and for purpose. You know, like we say to our investors, your money can do well and do good. And this is our view for organizations as well, Estelle, that you can make profits and do good. It's not a binary choice, but it does start and finish with purpose, in my view.
Great, thanks very much for that, John. Now, staying with you for a moment, searches by consumers of RIAA's responsible investment online tool shows that fossil fuels is the most searched for category that consumers want to avoid in their investments, whereas the benchmark report shows that managers agree on this, but beyond fossil fuels, negative screening approaches by managers and consumers don't always align. Consumers are looking for products that screen for human rights and animal cruelty, whereas responsible investment managers tend to exclude tobacco and weapons. Australian Ethical has been trying to build animal welfare considerations into portfolio construction. So can you tell us, John, what has precipitated this development, and why do you think other investment managers aren't as focused on human rights and animal welfare as consumers are?
Yeah, sure. That's a big question, Estelle. Thanks for that. But look, let's start with the positive, and Chris was touching on it before. And I think the positive is, you know, where consumer and manager expectations are starting to line up is on climate change, and that's a good thing. You know, everyone gets the threat, so let's keep going, everyone, and get going quickly on it. On disconnects, to your question, you know, consumers do have a much broader set of values and beliefs about what they care about, and it certainly extends well beyond, you know, simply whether or not something represents financial or legal risk. And I think that would be probably my criticism, or actually my challenge, you know, to non-leading managers, is that, you know, too many fund managers are focusing on just pricing ESG risks rather than actually doing the right thing, you know, factoring risks into valuations, but still often choosing to own the asset and invest, you know, and as Zuza was saying, actually allocating capital, you know, taking, you know, just talking about ESG risks, you know, can make investment managers appear intelligent, even virtuous, but it often really doesn't tackle the underlying ESG problem. You know, so I think, you know, this boils down to your investment philosophy, and at Australian Ethical, ethics are embedded in our investment philosophy, which means, you know, we automatically take a broader view of issues into consideration in every investment decision. We're not just valuing holdings through a risk and a pricing lens. You know, of course, we are looking at every investment financially, but also independent of financial performance. We're asking ourselves, are these the industries and businesses, you know, that have a place in a future world, you know, where people and the planet can thrive? And we ask ourselves, would our investors expect us to invest or not invest? You know, to your question about animal welfare, you know, I think that's an interesting example. You know, if you take animal welfare, you know, there is a huge gap between legal, you know, standard business practice and consumer expectations. Some will be aware the Department of Agriculture, you know, issued a research report which found a considerable difference between public expectation of farm animal welfare and the reality. You know, I think from memory, the report used the term outrage, you know, to describe the public's reaction when people became aware of the difference. So, you know, if you look at it just through a legal, you know, compliance lens, but don't go beyond that, you know, you're likely to make investment decisions that don't align with consumer expectations. So, you know, to your question, Estelle, yes, we make our assessments based on deep research. You know, we do use data from ESG providers, but we also source information from civil society, industry associations, NGOs, the CSIRO, science journals. You know, our investment team and ethics team does go and consult with experts. They look at industry and international standards, you know, and so we think about issues from different angles, you know, and grapple with the contentious issues. It's deep commitment, it's authenticity.
Great. Thanks very much, John, for those really useful insights that I think others can take away today. We know that consumers want sustainable and responsible investment, so I think that I agree with you. Better aligning with the specific consumer interests is one of the key next challenges for managers. Now, let's turn to what's happening globally and future risks and opportunities. Mark, based on what you're seeing happen in other markets like Europe, what do you think the biggest risks and opportunities are for investment managers over the next 12 months? And what do you think we can expect at around about the 10-year horizon?
Thanks for that question, and good morning, everyone. I think the clear sentiment from both the EU and the US is the focus on greenwashing, and specifically for investment managers. In the EU, we've got the Sustainable Finance Disclosure regulations, which was rolled out earlier this year, and that's requiring investors to disclose how they consider, specifically how they consider sustainability risks in their investment processes. And this really is raising the game in the EU. Last year's GSI survey, we saw EU responsive investment market actually contract in 2020. And I don't believe this is due to a lack of demand for the sustainable investment products, but it's because the policymakers are tightening the parameters around what's considered to be a responsible investment. And in the Biden presidency, we've seen significant calls coming from the SEC. So in April, they issued their risk alert that identified deficiencies and internal control weaknesses around ESG perspectives in investment funds, off the back of some regulatory inspections that they had been doing, and they issued a risk alert that showed that they had a number of observations where controls that were currently in place were inadequate to ensure that ESG related disclosures and marketing were consistent with the firm's practice. And we've seen this play out with the DWS investigation that's being undertaken by the SEC and the federal prosecutors right now. So that's what we're seeing overseas. In Australia, ASIC have launched their review into greenwashing of ESG and green funds, and they will be looking at practices, making sure that practices that the responsible investment funds are undertaking are aligned with the ESG claims of those products. So greenwashing has to be the focus for the next 12 months, but that's very much on the risk side. I think from the opportunity side, and I'm echoing a number of the other panelists' points, that if ESG integration is done well, it has to be a driver of investment value, and investment managers that are doing it well will continue to grow their AUM and win mandates. So we do know that institutional investors are measuring and monitoring the ESG performance and the climate performance of investment managers, and they're watching that very closely. So there are clearly risks around greenwashing for the next 12 months for investment managers, but my view is those that are doing it well, the opportunities are far greater.
Great, thanks very much, Mark. And I think your answer really highlights that here there's as much opportunity as there is risk. I wanted to focus on asset owners for a moment. Jesse, you're from an asset owner. What are the challenges that you think still exist to allocating capital towards environmental and social sustainability solutions?
Thanks, Estelle. Look, at the risk of just repeating kind of everything that everyone before me has just said, I think from an asset owner and institutional investor perspective, if we kind of take a step back and think about how this has kind of evolved, before my time in the industry, but definitely what I've seen over my career, we're definitely seeing, as Mark alluded to there, a movement from a sustainability and ESG integration being considered a risk management approach to it having a much broader focus, and absolutely solutions and a part of that. And I think, look, it's absolutely not mutually exclusive. It's not a risk management or a kind of impact solutions focus. There's the Venn diagram there is quite overlapping. But I think as that risk management approach has been better integrated into funds, managers have better understood how to manage that risk, we've also started to see some of the impacts of that. So, as we encourage better behaviours, as we encourage better practices in companies, as asset owners like ourselves get this idea of long-term thinking kind of out there, and that becomes embedded into investment approaches, we're seeing both the risk being managed and some of these impacts coming through. And look, well, as I said, like, it's not mutually exclusive. It doesn't necessarily change the process, but it does change how you talk about it. And it does change how you measure and what data you have available to measure. So I do think as this shift to outcomes happen, more managers are able to measure and to kind of understand what they're doing. We're absolutely going to see that develop. When we look at kind of appointing managers in our process, we look at sustainable investment from two angles. So one, does it do what it says on the tin? Are the managers able to tell us how they integrate sustainability and then demonstrate what their stewardship approach is, and then demonstrate how they do that in a way that is substantial and that we believe them? That totally makes sense. The other piece is slightly more nuanced, and I think that's where this is going, which is really, is what they say they're doing appropriate for the strategy that they're implementing? And then in the context of our fund-to-fund offer, is that appropriate for what we're trying to construct? Does that work with what we're trying to do as well? And to some extent, some approaches are going to be more easy to demonstrate impacts and demonstrate solutions than others. Classic example, listed equities versus index equities. Listed equities, active equities versus index equities. Different strategies are available to different managers in those contexts, and therefore they can demonstrate their impact in different ways. I'm sure that everybody on this call could participate in a very long debate about divestment versus engagement. Similar idea as well. And as the others have alluded to, some of the movement we're seeing in the EU around regulation, I think, will help this, both from the consumer point of view, also from the kind of, the underlying managers and asset owners point of view, in terms of making sure that we can align with what the consumers want, and what we're saying aligns, what we're doing aligns with what we're saying and aligns with what the regulation says, and the consumers can understand that. And that's really where we kind of have tried to focus our time a little bit, is draw some of those insights that we have from the institutional space and apply that, and help apply that to our platform, provide tools and resources that can help people understand that a little bit better.
Great, thanks very much, Jessie. Mark, I might ask you the same question. In working with your clients, what do you think the main challenges you're seeing sort of in the sector as a whole are with regard to shifting that capital towards sustainability outcomes?
Yeah, thanks for that. So I think the main challenge is to embed the consideration of ESG risks and opportunities into the governance, risk and investment processes. The commitment to ESG strategy is an easy first step. And I think the slide that you showed before that showed the difference in performance between the leaders and the non-leaders really highlights the key challenges that we see. So when we go to commitments, both the leaders and non-leaders all could make their commitments, but there were significant differences when it comes to that systemization, that systematic process to embedding the ESG risks into processes. And similarly with stewardship and the allocation of capital to target ESG outcomes, the gaps are much greater. And I think that really indicates where the challenges are. It's about driving ESG understanding throughout those processes. So we've been working with a number of clients around using the RIAA framework and other guidance from RIAA, as well as CPG 229 as a framework to test and give some comfort to directors and trustees around how well that ESG is being embedded through the processes, through governance, risk and investment processes, and identifying where those gaps are and what can be developed and improved. But thinking about the opportunity side, we've been working very much with our private equity clients here in Australia and leveraging work that's been done by my team in Europe and in North America, thinking around how ESG preserves and creates value throughout an investment cycle. So thinking about it across 3 steps, the pre-deal step, thinking about screening and the due diligence. So to understand how this asset that I'm going to acquire will contribute to my portfolio and to my impact at a portfolio level, but then thinking about ESG across the whole period. So developing a clear ESG value creation approach, and operational improvement roadmaps and that sort of thing. So we're maximizing our value at exit, but also the ESG contribution to growth that's when it's being realized. So to me, this is the most exciting part of this, because we're beginning to look at ESG as a driver, ESG integration as a key driver of value creation, rather than the risk-based approach or the reputational approach that we've seen before. So we're moving very much into a value creation phase, which I find really exciting. I think that's when we'll start to see differences being made in the real economy and in our societies and our community.
Thanks, Mark. I mean, I think, although the responsible investment market has continued to grow and we're seeing these funds engaging in leading practice have seen this explosion in assets under management, there do remain challenges. And I think, Jessie highlighted one before, which is the measurement and reporting. But I think, also that sort of embedding ESG into the processes is another one. Also doing better at stewardship, I think, is another key challenge going forward. Now let's talk about the big issue of financial performance. Grant, this year's benchmark report findings show that investment managers no longer believe that they have to trade off returns to invest responsibly, and certainly this is an encouraging finding. We're also seeing that Australian responsible investment funds don't outperform the index. In fact, their returns are starting to converge with the index. So given that leading responsible investment funds now make up a full 40% of total assets under management, is this 1 year finding reasonable? And Grant, what do you think we'll start to see in future years or out to sort of 10 years?
Well, firstly, I'd say we don't want to be making definitive judgments based on 1 year numbers. So, but personally, I do agree that there's a theme that you don't need to sacrifice returns over the long term to invest in a sustainable manner. but consistently adding value through security selection is a very difficult task for any asset manager, and particularly in the relatively narrow Australian market. By the nature of their holdings, many sustainable funds outperform when like quality and growth factors are driving markets. And we saw this in the first half of 2020, but you get to the second half of 2020 and first half of 2021, materials and energy rebounded strongly. This makes it tough for Australian funds not exposed to these sectors to outperform. So, you'll have these short-term periods of potential underperformance versus market benchmarks. But looking more long-term, the consideration of material ESG risks is going to continue to be essential for investors to include in their analysis. All investors will be doing this. So at a point in time, we'll just stop talking about responsible investing and just talk about investing. And so hence my answer is to your question is, in the longer term, these different manager buckets, they're just going to converge and we'll just be talking about investing. So what's important is better data disclosure by companies and asset managers. It's going to be an important part of this journey to meet investor expectations and increasingly government expectations through regulation. Personally, I'm pleased to see that compulsory portfolio holdings disclosure is closer to reality in Australia. This has been an embarrassment for the Australian industry for over a decade. I'm pleased to see we're making these small steps of asset managers actually having to provide their portfolio holdings disclosure during super. That's not enough. It should be non-super as well. We really need to get somewhere near global standards, and we're still not there. But this data-driven, this data is going to be very important to disclosures and how we evolve as an investment management sector.
Great, thanks so much. I think that's a really interesting answer, sort of calling out government to do a little bit better in terms of regulations and legislations. Now, finally, just one last question for Jessie. We're seeing that this is a maturing market. The responsible investment market has reached, I suppose you could say, the first stage. So we're seeing this convergence of financial performance as responsible investments expanding and, as Grant has just said, becoming mainstream. So when we compare leaders and non-leaders, the level of commitment to responsible investment is about the same. What's the next stage? What do you expect to happen next, Jessie?
Yeah, well, I mean, at the risk of just repeating everything that everybody said on this call, I think we've kind of covered some of that. But I think, I think Grant just mentioned it there. We're definitely coming up the curve. Better disclosure, more information. Both institutional investors like me, and then also kind of end investors, advisors asking for more kind of information, providing more information is just going to kind of help this, this whole kind of space into that kind of next step. As you said, it's no longer, responsible investment is not only just mainstream, it's now just, it's becoming investment, right? And, if you're not, if you're not applying some kind of responsible investment to your fund, then why not? Really is now the expectation. I think where we're going to, and if we kind of again look to some of the earlier comments we made about overseas, where we're going to is, I hope, my personal bugbear, a bit of a convergence between these conversations that we've been having as an industry about what is responsible investment and all the kind of terminology that we use, and the understanding from the retail market in particular about what sustainable investing is, and a better understanding of what their expectations are and how that fits into kind of their broader financial plan. And I think kind of as, investors get better at explaining to investors get better at explaining to their kind of, that kind of retail customer base and to Australians, as John kind of said, what they're doing and why they're doing it. I think we'll also see, those retail investors and kind of the broader community have a better understanding of what some of these tools are that we use and how effective they are. And I'm genuinely really interested to see, and I don't really have a prediction, but I'm genuinely interested to see how this develops. Are we going to see investors asking more about engagement, asking more about stewardship? Are we going to see investors, more interested in positive screens and more interested in what you are investing in, less interested in what you're not investing in? Is that how it's going to develop? And I think, we're all here, especially, providers of superannuation, but all of us are here to help wealth creation and, to provide a product for our members and investors. So being able to respond to what they want, and the better kind of education across the industry will be really, I think, beneficial. And I think that's what's going to drive it forward.
Can I just add one thing just one thing to what Jess said is the difference between investor expectations in the industry. I found that slide and comment in the report interesting about the searches about tobacco. And I think there's a mismatch, but the average investor probably just does not expect tobacco to be in their portfolio. You know, they're not searching for it because they're thinking, why would tobacco stocks be in my portfolio? So I think there is this mismatch between the industry. Oh, look, we're tobacco free. And investors are like, of course you're tobacco free. You should be tobacco free. So I think that's the gap.
Sure, no, that's a good point. We'll put that on the list for future RIA research. Just turning back to the crystal ball, Nick, as RIA's policy expert, it's your job to follow these developments quite closely. So do you have anything to add about what do you think's next? What's your crystal ball telling you?
Okay, well, if you indulge me to liken greenwashing to COVID for a second, and complete respect to people who've been impacted by COVID in ways, but I'd love it if everyone just rushed to have their products certified against the responsible investment standard. And that would effectively immunise the industry against the sort of slanders of greenwashing, right? But sadly, that's unlikely to happen, and there's no regulator talking about a lockdown on greenwashing anytime soon. So in the meantime, I just implore less talk and more show. And by this, I mean less talk about activities and more evidence demonstrating the outcomes achieved or not. Aussies do like an honest and balanced view of performance. And I mean that on the environmental and the social performance through how money is allocated, and even on engagement, and not just with companies, but also with governments. So probably I'd say turning up to sustainability is probably the crystal ball part here. And, to echo John McMurdo's points, targeting things that matter. So diversity is not just about looking at having one or two women on a board. It's not about tackling one or two of the Sustainable Development Goals, and certainly not just about SDG 8 around economic growth. And frankly, nor is it decarbonising a portfolio. That's just what we all need to do at pace now. That's the new business as usual. So probably, Estelle, I'd say my crystal ball is telling me that leaders in this decade are storytellers that find their purpose, and that they can tell and show their clients and members both what they stand for and how investing with them can make investors be part of that, kind of create that cleaner, safer, more sustainable future that they want to create for themselves.
Fantastic. Thanks very much, Nick. And we're certainly looking forward to next year's report to see whether that call to arms, I suppose, comes to fruition. We've had a question for Mark from the audience. Mark, last year you highlighted a dissonance between the growing ESG responsible investment good news story and the realised outcomes, which failed to show a timely shift towards a sustainable future reflective of the Paris Agreement. Through your engagement with this year's results and supporting RIA's research role, do you feel like anything has meaningfully changed in the last 12 months?
Thank you. That's a very interesting question. I think on the whole, capital markets have taken climate risk more seriously and continue to do so. I think TCFD and understanding of value at risk through climate is really finding its mark as an investment risk now, and it's being treated as an investment risk rather than a esoteric sort of outside non-financial risk. So that change continues to percolate through, but I still believe that the potential impact of climate risk on the economy and the environment still isn't truly reflected by capital markets. I think the IPCC report indicated the level of urgency, which I still don't see being reflected through investment decisions, both from asset managers, but also from a lot of the corporates that I work with. That urgency for change is still not there. And I still think that will play out and with increased value at risk. So the capital markets are moving, but I think it's reasonably difficult for capital markets to go further without support from government legislation. That's still missing in Australia. The Europeans have got the benefit of the SFDR and EU taxonomy to give them that structure to drive change. I think APRA's been very active this year, which I think is superb. I think they're doing a great job around providing the market with some guidance and with some regulatory encouragement, however gentle that may appear at the moment. But I think also ASFI to me is going to be increasingly important. And I truly hope that the industry rallies around ASFI and makes that as successful as it can be, because it is a good chance to change the industry in which we all work.
Absolutely, thanks, Mark. And yes, that ASFI roadmap, I think, really does give the Australian sector a really fantastic way forward that everyone can kind of contribute to. Great, so time for one last question. I think we've had a couple of questions for the panel on impact investing and whether panelists have a sense of how investors operating in impact investing versus sustainability theme investing, how investors view transition-linked instruments. Nick, I might pass over to you to answer that question, and perhaps you could give a comment on impact investing generally, and any other sort of panelist might also chip in.
Thanks, Estelle. I have just posted a response in the chat, I'm hoping, on that one. Just to give it a very quick high-level piece, that it's a really interesting question. I think there's still a bit of a cultural divide within the responsible investment community, as we have the spectrum, those up the end doing sustainability, targeting sustainability solutions with sustainability themed and impact investments, and those just trying to pick up the back end and have a sector or have an economy we can invest in, right? We still need to have a diversity of stocks. So I'm very pleased to see that this 31% upswing in those engaging companies also reporting on the outcomes of those engagements, for example, and the voting on resolutions that are relevant in terms of disclosures that improve decision-making on ES and G factors. But we are seeing this, to the question from the participant, we're seeing this sustainability-linked bonds booming. And there are some sustainability-linked bonds that you kind of go, scratch your head and go, that's really creative. But there's a real question around that that's additive in terms of the real economy. So some of it's really just rewarding or providing some incentives around what we would probably call good corporate social responsibility. Then there's other ones that are really targeting the types of things we'd expect in making a difference in the real economy around anti-recidivism or tackling some gaps in affordable housing. So probably just to say they all have a place to play. And I suppose that's why it's so important we have transparency, so we can actually kick the tires around some of these instruments that come to market, and for ourselves, with our own set of our own interests and our own values about what leads us to different products and services, where we can make an informed choice whether that aligns with what we want to achieve with our own investment objectives.
Thanks, Nick. Did any other panelists have anything to add on impact investing?
Still, maybe the only comment I would add, of course, at Australian Ethical, all we do is ethical investing. It's all we do. It's everything we do. So not surprising, we go and research, consumers and our investors all the time, intra-year. And what I saw was interesting in some of our recent research was that for the first time ever, those who actually want to see their portfolios doing good was a higher proportion of the population than those that just wanted to see harm avoided. First time we've seen that. So quite an interesting bellwether, I think, on impact that investors in the market generally are looking for.
I'll just make one additional point, that there is increasing investor demand, but there is actually not a lot of product in the marketplace as well, if you're specifically looking for impact. So if you're trying to build a portfolio, with Australian and global exposure, bonds and equity, it's tough to actually build a full portfolio. So I think the industry has more to do there. And so in the immediate term, you've also got money, running into a small number of opportunities, which is going to create potentially liquidity issues. So I think it's a space that has to get watched closely. I think it's definitely the future, but in the short term, there's going to be some bumps on the road.
those millennials, but lots of opportunity there. Look, that was a fascinating discussion. Thank you to everyone, to you, the audience, and to our panel members. Grant Kenaway from Morningstar, thanks again to Morningstar for the data support that Morningstar provided for this report. John McMurdo from Australian Ethical, Jessie Pettigrew from BT, Chris Willey from AXA, and Mark Spicer from KPMG. And thanks KPMG for your input into this report. Thanks again to our business partners, Australian Ethical, BT and AXA Investment Managers. And congratulations to the amazing team who contributed to this report, Nicolette, Truja and Mark, and also Katie Braid, Samantha Bayes, Elise Bourne and Louise Jacobson. To those who've joined us today, we hope that you've gained an insight into the state of responsible investment in Australia. For more information and for more detail, please read the report. And of course, if you'd like information about the many benefits of being a RIAA member, including to influence RIAA's future program of research, please don't hesitate to get in touch. Thanks for joining us.